Thank you so much. So now moving on to our fifth session for this marathon, which certainly has the most number of amendments, is provisions of charitable trust and institutions. We welcome Dr. Manoj Fogla, Senior Partner at Saga Law LLP, to take us forward with his insights. He's an expert on taxation, CSR, FCRA, governance, and accountability issues. Also joining him is Mr. Suresh Kumar Kejriwal, a practicing chartered accountant and a founder partner of Messrs. Agarwal Kejriwal and Company, Chartered Accountants, Kolkata. A cordial welcome to sir.
Good afternoon. Shall I start?
Yes, sir. You can share your PPT and the screen, and you can.
So, good afternoon, friends. So today, this 45 minutes we have structured in such a way that I will share an overview. Then Sureshji will methodically run through the various amendments, and as we go along the amendments, we will discuss the various issues and the controversies and the debatable issues which arise out of this amendment. So this is the structures, and towards the end we will take whatever questions which you may put in the chat box. Now coming to the budget, before going into the exact amendments, we should understand the pattern of amendments regarding charities in the last few years. If you see, there was a time in 1983 when our finance minister, Pranab Mukherjee, former president, Pranab Mukherjee was the finance minister. The words "not for any activity or profit" were deleted from charitable purpose. In other words, charitable purpose was amended and liberalized that even activity or profit can be treated as a charitable activity. In 1990s, we had Supreme Court cases which said that any kind of business activity done by a trust will be incidental if entire income is deployed for charitable purposes. So this was the kind of a liberal environment in charity used to exist, and there was very little compliances as far as charity is concerned. But from 2008 onwards, 2008, we found that the definition of charitable purpose was amended, and any commercial activity as a part of charitable activity was considered as a reason for treating an organization as a non-charitable organization. Then we had various amendments, which I'm not discussing today, cancellation, and the entire corpus being taxed as maximum marginal rate under section 115 TD, and so on. Now, if I look at this year's amendment, then what I see, the larger patterns of this is that the government is giving a very clear message. The government is giving a very clear message. Charitable organizations which are engaged in direct delivery programs, for instance, a charitable organization engaged in education, health services, or both education and health services, these kind of organizations, no questions asked, up to 5 crore rupees, they don't need registration, just by mere declaration while filing the form, entire income could be treated as exempt. Bearing these two sections, 1023C3AD and 1023C3AB, were up to 5 crore rupees turnover for a charity could be gross income as well, is exempted. For all other charitable organizations, there have been a slew of amendments last year, this year, prior to that year, and it has made charity compliances very cumbersome, and the charity assessment, cancellation, appellate proceeding, etc. Everything has been structured, and many of the amendments raise many questions which we will try to discuss. Another important thing which I find in this year's budget, which is a very big takeaway. Sometime back, there was a Delhi High Court decision in the case of Petroleum Sports Foundation, New Delhi, where what happens normally if a charitable organization loses 12A registration, or it is not allowed the benefit of section 11, then it is taxed under section 56 and section 57. And the AO used to tax the gross income. because charitable activities were not considered as expenditure. They can be treated as application. So Delhi High Court said that charitable organization, all charitable expenditure should be allowed as application. And this has been taken, by this amendment. Now the new amendment says that if a charitable organization loses exemption, charitable organization is not fulfilling the conditions of section 12A, then also all the expenses made on charitable activities will be allowed. Now, if you see, last year we had amendment in CSR rules. What CSR rules are saying? CSR rules are saying that the company has to ensure that the money is utilized. The unspent balance cannot be kept with the foundation which is utilizing it. So under CSR rule also, whatever you receive, you utilize it 100% or you give it back to the company. Under income tax law, there is a similar pattern where the government is trying to say that, look, you receive money, you spend 100%. You don't need 12A registration. Of course, there is no amendment in section 56, 57, but the very fact, this new section 1310, which has been added regarding taxing and allowing expenditure. So these are a few of the big issues which arise from the budget. Now, this year, another major issue which has come, which is regarding to the extensive powers to the AO and the commissioners, which I am not discussing, but one or two to set the context of our discussion. I must share that charity was supposed to be an altogether different code. That means if you see charities assessment, charity sections are 10, 11, 12, 13. So these are the four sections under which everything about charity happens. Section 10 is about, earlier section 10 was unconditional exemptions, but for charities, many conditions have been added. Then you have section 11, 12, 13. From section 14, Income Tax Act starts. So charity, the code, taxation, assessment of charity was entirely supposed to be before this 5 heads of income. Section 14 is 5 heads of income. So no income of charity is supposed to be taxed under 5 heads of income. There was a lot of lack of clarity if the income of a charitable organization was forfeited, or if a charitable organization had not filed the return or had not done the audit. In such circumstances, invariably throughout the country, we would see assessing officers making the assessment under the normal taxation principles, under the 5 heads of income. That clarity has come this year, that as long as your 12AB registration or 1023C registration is alive, even if there are violations, even if there is forfeiture under section 13, even if there are specified violations, an organization will be assessed, taxed, and all provisions will apply within those 4 sections. No sections outside these 4 would apply. Once the registration is cancelled, then this normal, traditional, and other provisions will apply. So these are some of the larger context and contours of the amendments which I see. Now I invite Sureshji to methodically take us through the amendments which have happened, and as we go along, we will try to see what are the challenges and issues which are coming. Sureshji.
Thank you, Manoj, for setting the tone for today's discussion on the amendments. And let me share my presentation. I'm not able to share my screen.
Sir, it is visible now, sir.
But I'm not able to share my screen, my PPT.
Sir, your PPT is visible now. You may cursor it down, sir. It is visible.
Okay, fine.
Perfect, sir. Thank you.
So the key amendments we are going to discuss today is the provision for cancellation of registration or approval, because there are very, very key amendments here. Then there is a effort to make the 2 exemption regime at par. 2 exemption regime means the regime under section 1023C and regime under section 11, 12, 13. They have also dealt upon with very strictly the benefit related person. Then they have specified computation of income in certain situations. They have also specified a special rate of taxation of certain defined income. They have put on the additional requirement to maintain the accounts. They have also said that you have to, the computation of application amount has to be on cash basis. And they have also given certain leeway on the certain voluntary contribution received by the religious institutions. So let us take one amendment by one. We have to second, next slide. Yeah. Is not, I am not able to move this slide. Next slide, please. First slide, back. Back जाइएगा थोड़ा. Yeah. So section 12.4 and 12.5, which deals with the cancellation provision, there is the total section has been substituted by the new section. And now 12.4 earlier provided very limited situation where the registration or approval can be cancelled. Now they have made a separate subsection summarizing the specified violations against for which the cancellation can be happen. And this includes if the income is applied for purpose other than the object. Then they say if there is an income in the trust for non-incidental business activity. Because we all know the incidental business activities are covered under section 11.4 and those are allowed. But they are saying if the trust is having income from non-incidental business activity, then that can be the ground for cancellation. Then they are saying if, as 11.4a says, you have to maintain a separate set of books of account for incidental business activity, and if you are not maintaining that accounts, then that can also lead to the cancellation. Then they are saying if applied income of benefit, if you are the trust is applying income for the benefit of any particular religious community or caste, then they are saying if the activities carried on are not genuine. The very, very vital amendment is inclusion is the activities are not according to the registration conditions. Now we all know at the time of 10AC we received a number of conditions attached with 10AC form, and those conditions are not as required under section 12A and 11, 12, 13, and those are the additional conditions imposed by the CIT at the time of issuing the provisional or normal registration for 5 years. Now they make it mandate, they make it authenticated that registration, and they are saying if the activities are not according to the registration document, then also your registration can be cancelled and the non-compliances with other laws. Now, next slide. Now they are saying how this will be detected. They are saying occurrence of one or more specified violation during any previous year will start the cancellation proceedings. And for this, the reference from assessing officer under second provision of section 143.3. Section 143.3 has been amended, and the assessing officer has given a power to refer if he's satisfied that any of the specified conditions has been violated. Then before making the assessment, he can refer the matter to the CIT for initiating the cancellation proceedings, and he has to wait for completion of the assessment till the CIT finds out whether the cancellation proceedings are okay or not. And again, the third way is the case has been selected in accordance with the risk management strategy of the severity. So these three the lead for going to the cancellation. Now the issue arises. Next slide, please.
So now, if you see, these are quite interesting and questionable amendments which have given, because normally a cancellation proceeding is an last and a residual proceeding. In other acts, for instance, in FCRA also, a cancellation will be preceded of assessment, then departmental audit, and after audit there would be suspension proceeding, and if there are findings in the suspension proceeding, it may result in cancellation. So now this new amendment, which I hope maybe will be revisited, says that during the assessment, while the assessment is not complete, can make a reference to the CIT. In other words, without completing the assessment, the Commissioner of Income Tax can initiate cancellation proceeding, which I suspect needs reconsideration, because a cancellation proceeding the prerequisite for a cancellation proceedings is there. There has to be a finding in possession of the commissioner or a AO, which suggests that the organization has done or violated the conditions or the compliances which have been violated. Because, for instance, Section 13 violation earlier, if there are multiple Section 13 violations, then we used to see the Commissioner of Income Tax giving a cancellation proceeding initiation. Now, the other thing is that the cancellation proceeding can be initiated just like a 143(3) scrutiny assessment, that under a risk mitigation strategy or some other which we don't know, the government may prescribe, a cancellation proceeding can be initiated. So these are two very contentious amendments. I'm sure they will be revisited, or in times to come they will be challenged, because they defy natural justice. And if these amendments are sustained, then it will be like in the statute itself, roving inquiry will be permitted, we can say, the statute itself, because the second says that if the AO is satisfied, it can refer the matter to the CIT for cancellation. But how the AO will be satisfied even before the completion of the assessment, because the assessment itself is a complete process where so causes have to be issued, draft assessment order has to be issued, the SSC has to be provided all opportunities. All those processes will be held, and the cancellation proceedings can be completed even before the assessment, and the CIT may inform the AO that this organization has been cancelled and the assessment will be done as a non-registered organization. So this is quite a harsh change, and it's we think it will be revisited.
Next slide, please.
This is another very important thing, because whoever has received this 5-year renewal, all existing organizations have received renewal for 5 years. The renewal certificate or the 12AB registration certificate or the provisional registration certificate under 1023C or 12AB nowadays have a lot of conditions. I think 14 of such conditions are there on those certificates. But if you see the Income Tax Act, the Act provides the conditions of registration. Section 12A has been provided in the statute to give conditions of registration. So now the question arises, can the Commissioner of Income Tax put conditions over and above what has been provided inside the statute? To our understanding, there is no provision, there is no discretionary power to the Commissioner to provide conditions which are not there in the statute. Already there are various conditions under Section 12A, including maintenance of books of account, filing of return. If you don't file a return, that itself is treated as a violation of 12A, which could result in cancellation, which itself is a very strong and harsh provision. Failure to do audit and all those kinds of. So to my understanding, this condition should be read, the condition as provided in the Income Tax Act. It cannot be conditions issued at the discretion of the issuing authority, because in the past also it has been held in various high courts that any conditions provided by the Commissioner of Income Tax exemption at the time of registration are void in law, because conditions have already been enunciated in the Income Tax Act, and those only will be binding. I think those rulings and that interpretation of the statute will still remain, and condition will be the conditions imposed in Section 12A could be a region of condition, and the specified region, as we discussed in the previous slide. These are the things which will result in cancellation. I don't think the new conditions, which are nowhere found in the Act or the rule, imposed only in the certificate, can be a valid reason for cancellation.
Next slide, please.
This is
Next slide.
This we have discussed, because now this is quite for us, we are unable to understand that can a cancellation and an assessment, we understand that a summary assessment could be converted into a scrutiny assessment based on various strategy or sampling. But can an organization's registration be cancelled based on a risk management strategy? That is something very new and unusual, and it is not in sync with the other provisions of the Income Tax Act and even the other statutes, particularly the FCRA, which is a parallel statute. FCRA itself is considered to be a very harsh statute by many of the charitable institutions. Even there is a suspension proceeding prior to cancellation proceeding, and even for suspension proceeding, reasons and findings have to be recorded even in FCRA. So without recording reasons, just based on a risk management strategy, would tantamount to a roving inquiry, which probably may not stand the constitutional validity of the provision, but we don't know. Time will tell.
Next slide, please. Regarding the procedure to be followed on this cancellation proceedings, I think there is no change. The CIT has to give so-called notice. The reasonable opportunity of being heard has to be given. Then, if the CIT is not satisfied, he can pass the order in writing, refusing or cancel the registration, and forward the copy of that cancellation order to the AO also, to take effect of that pending assessment order if the cause of initiation is from the assessing officer. Next slide. Now, earlier there was no timeline mentioned to come what period this cancellation proceedings is to be completed. Now, as per the new proposal, the timeline to complete the cancellation proceedings is provided to be 6 months calculated from the end of the quarter in which the first notice is issued by the PCIT. So now there's a different time frame given to complete this cancellation proceedings, and this is only 6 months from the on the first day, first notice issued by the PCIT here. Next slide. So this is all about the cancellation. Now the second most important amendment is consistency. Effort is made to broad consistency in two exemption regimes. Next slide. And the two exemption regimes are basically 1023C and 12AB. Now we all know there are a number of conditions which are applicable to 12AB, we are not applicable to 1023C. Now, as per the amendment, now there are required five conditions which were applicable to 12AB, were made also applicable to 1023 entities. What are those additional conditions? The requirement of furnishing of income tax return as a condition. Though the 1023C NGOs were required to submit return, but it was not a condition to claim approval, as like in 12AB. So now the relevant provision has been amended, and now furnishing of return becomes a condition in line with 12AB. Now requirement of uploading the audit report, that has also become a condition in line with the 12AB. Now there was no restriction on payment to a specified person, as we have 13(1)(c) in 12AB provisions. Now the similar line provisions have been inserted in 1023C. Similarly, though we have to accumulate 85%, spend 85% in 1023C, and we can accumulate for 5 years, but there was no explicit provision how to accumulate that part, whether we can give to interchange donation or not. I think the accumulation provisions under section 1023C has been amended and made in line with the 11(2) provisions under the 12AB regime. And lastly, we all know this cancellation proceedings aggregated tax under 115 TD was applicable only to 12AB regime. Now it is also made applicable to 1023C regime as well. That means under both the regimes, there is a provision for cancellation of registration or approvals. So these are 5 broad changes brought in under 1023C to make it in consistence with the 12AB regime. Parallelly, whatever new amendment they have made in 12AB, like books of account, cash basis of accounting, all those changes have been also inserted in 1023C regimes. That means all the new proposals which are applicable to 12AB are also made applicable to 1023C. So for every amendment, there are two amendments, one for 1023C and one for 12AB. And that's why the number of amendments looks very, very large in numbers. Next slide. However, still we find there are certain differences remains. Now the provision for application of income outside India is not there in 1023C regime. The option to spend in subsequent year or in the year of receipt for which we submit 9A form is not there in 1023C regime. And similarly, there is a retrospective exemption benefit can be claimed under second provision of 12AB, but there is no similar provision in 1023C. So on these three accounts, still there are differences are there. We understand this is a move towards one regime from the existing two regime. Otherwise, there is no point to have two exemption regime with the similar provisions. Next slide, please.
So now the question arises because we always used to believe that 1023C is a superior form of approval, and it was supposed to be awarded to organizations which were of prominence in the state or the country. But after this year's amendment, there is virtually no difference between an organization registered under 1023C and Section 12AB. In the hindsight, it might be beneficial to have a 12AB registration, because if you have 12AB registration, if you see Section 12A, subsection 2, the provisions under subsection 2 of 12A provide a blanket immunity from tax and penalties to 12A registered organization for all open assessments. So if you get 12A registration from the, say, assessment year 21-22, and even if there are proceedings pending for earlier years, for all those years, you will get benefit of Section 12A once you have been allowed the benefit prospectively. There is a deemed retrospective effect. That particular provision is missing under Section 1023C. So in that sense, if you are an organization, ongoing organization, or an organization which has pending cases or 263 notices pending, those kind of organization, it might be advisable to go for 12AB registration rather than 1023C. And 1023C also, basically 1023C, we see solely educational and solely medical institutions. We don't see too many institutions which are general charities. Under 1023C, you can have a religious institution, you can have a general charity, you can have an educational institution, you can have a medical institution under the approval category. Under the non-approval category, primarily you can have medical and educational institutions. So now you have two categories: the educational and medical institutions which don't require any registration, and 1023C and 12A registration which are similar. 12AB might be having some slight advantage.
Next slide, please. Now the next key amendment is provisions regarding benefit to a specified person. And this is this non-compliances has been taken up very seriously by this amendment. Now they have made it very clearly what shall be the amount of default if the benefit is given to a specified person. When we are saying benefit means somebody is given what is not due to him. So the amended section says the section 13(1)(c) deals with the implication of providing unreasonable benefit to the specified person. Earlier, providing unreasonable benefit, earlier means presently, providing unreasonable benefit has resulted into withdrawal of applicability of section 11 and 12, but there was no clarity on what amount the income shall be subject to tax for penal taxation. Now the proposed amendment has bring it clearly defined that if the benefit is given to a specified person, then the amount of the benefit as unreasonable benefit shall be the deemed income. Now there is clarity that the total section 11(12) will not be withdrawn from that particular assessment, but only that amount that has been given as a benefit to the specified persons and which is considered as a violation, then that amount shall be subject to tax. Now again 115 BBI has been inserted, and they are saying, and this section provides that such income shall be charged to tax at 30%. That means normally the AOPs are taxed at as an AOP, that means slab rate, and 100 section 164(2) provides that 13(1)(c), the charging section would be the maximum marginal rate, but the newly inserted section 115 BBI says only 30% tax rate will be on such income, and but there is no corresponding change in 164(2). Next slide. Now again, they have not stopped here. They have inserted a new section 271 AAE, specifically dealing with the unreasonable benefit given to the specified person 13(1)(c). And they are saying in such cases where the unreasonable benefit has been given, then that shall be also subject to penalty. Penalty under newly inserted section 271 AAE. And what this section says, that in the first previous year, if the such benefit is deducted or observed by the department, 100% of the amount given as an unreasonable benefit. In the subsequent year, again, this violation is noticed, then we have to pay 200% of the amount. That means 30% tax and 100% penalty in first year, and subsequent year 30% tax and 200% of penalty. And again, when we see the 12AB4 provisions, the situation for cancellation, where they says where income derived from property has been applied other than for the object of the trust, then the CIT might consider this application as an unreasonable benefit to the specified person can be applied for other than the object of the trust. So this payment to the specified person that is unreasonable benefit can also be a reason for cancellation. So basically, this has taken up very seriously by the department, and they have to make it clear what's the amount of violation, but the tax rate has been specified, penalty has been specified, and this can also be the reason for cancellation. And the similar provisions has also been inserted under 1023C. Next slide. Manoj.
Now, there is a lot of confusion regarding that any payment made to specified person may also be treated as a benefit. So in that sense, we should understand that the tax laws, particularly section 13(1)(c), is structured in such a way that actually it enables all kinds of transaction with related parties or persons who have a stake or interest in the institution or are governing or are in key managerial position. So for the purposes of today's session, we should keep benefit is something which is not due to the person. So any kind of arm's length transaction, any kind of remuneration, any kind of consultancy, it will be treated as a valid payment, and those will not be attracted. We'll just quickly run through the next slide. Now, this is a very important thing. We should understand that the benefit to specified person directly has been treated as a reason for cancellation. In the past, there have been cases where it has been held that the benefit should be a material amount and it should be backed by a deliberate intent to use public funds for private benefit. Any small benefits provided to specified persons should not be treated as a reason for cancellation, but no such exclusion or explanation has been provided in the Act. So this is one area which will require clarity. Otherwise, even a small benefit could be treated as a reason for cancellation. That possibility is there.
Next slide, please.
We have touched this. We can go to the next. Yeah.
Now the second very important amendment is we all know 12A gives certain conditions to be followed. Again, if there is a 215 violation, 1112 benefit is not there. And as per the current practice or as a current understanding of the law, whenever there is a violation of 12A conditions or whenever there is a applicability of section 215, the benefit of section 11 and 12 is withdrawn and income is computed in commercial sense, computed as per the normal provisions of the Act. Now, the new section 1310 has been inserted to take care of these situations. And they are providing that in case there's a 215 valuation, in case where books of account are not maintained, in case where audit report has not been uploaded, or in case where returns have not been submitted, in those cases, they have given a separate mechanism to compute the income as per section 1310 newly inserted. Next slide. And as per this newly inserted slide, next slide, please. This says the income chargeable to tax in such cases where there is a violation of specified conditions computed after allowing the expenditure other than capital expenditure. That means in normal computation, we claim both revenue and capital expenditure, but they are saying for this purpose, when there are violation of conditions or there's violation of 215 condition, then you can claim deduction of only revenue expenditure that incurred in India, subject to the following conditions: that the expenditure is not from the corpus fund, the expenditure is not from any loan and borrowing. There cannot be a claim of depreciation in respect of asset which has already been claimed as application of income. Then the expenditure should not be in the form of any contribution or donation to any other person. That means inter-charity donation we have given, that will not be considered while computing income under this provision. Then the disallowances will be made for the cash payment and the non-tedious cases in the normal, as per the normal computation provisions. And they are also saying no set off of earlier losses. So basically now they have made a separate computation, provided for a separate computation provisions, and based upon this, the tax, the income chargeable to tax will be computed and shall be subject to tax. Next slide, please. Manoj. And now the Manoj.
Yeah, sorry, I was on mute. So this particular section is very important because this has created a paradigm shift in the way the taxation of charity will happen in case of violation of conditions of registration. In the past, the understanding was that if the conditions of registration were violated, there are two sets of violations primarily under the Income Tax Act. Section 12A is about conditions of registration, and Section 13 is about various specified violations. So when specified violations used to happen, the organization was still assessed under Section 11 to 13. But if there was a violation under Section 12A, then the organization used to be assessed under 5 heads of income. But from this year onward, this clarity has come. If an organization has not fulfilled any conditions of Section 12A, she has not failed to do the audit or not maintain the books of account and the other 4 or 5 conditions which are there under Section 12A, still that organization will be eligible for all the charitable expenditure which was earlier under question mark, and will be assessed as a normal charity, though without benefits of Section 11. Whatever the surplus will be there, it will be taxed. In some sense, it is a strong section. In some sense, it is a takeaway that at least charitable organizations will be allowed all charitable expenditure except inter-charity grant. Now, Sureshji, we don't have much time, so we just have to rush through our project.
Okay, right, okay. Next slide. Next slide. Now, we all know as per the existing law, there are certain incomes, and that incomes comes from the non-violation, and that are not available for application. That means those incomes are directly charged to tax. And what are those incomes? The income under Section 11(1)(c), that means where anything is spent outside India without permission. That's income under Section 11(1)(b), that means we have applied for to option and we have not spent. 11(3), we have applied for accumulation, we have not spent. Then income under Section violation of 13(1)(c) or income under Section 13(1)(d). And also they have included that income accumulated or set apart in excess of 15%, meaning thereby, if you have 100 rupees income, if you spent only 80 rupees and you have not claimed any benefit of option and accumulation, then 5 rupees becomes excess subject to tax. In all these, for all these 5 categories of income, they have inserted a new section 115 BBI. And this is if you have income of this nature, which are not applicable for application, next slide please, then this shall be separately charged to tax. As per the present provision, these are subject to charge to tax as an AOP. That means we have the existing slab rates applicable after 2.50 lakhs. But now, as per the 115 BBI provision, this shall be taxed at 30% of the this is flat income. And if the balance income is there, then that shall be calculated as an AOP. And what can be the balance income here? The income as per 1310, which we have just previously calculated, that in the case there is a condition condition is violated, and the newly inserted section 1310 has come. If the income is computed as per that, then that income is not covered under section 115 BBI. That means, as per our understanding, that income shall suffer the normal taxation as an AOP, but other income is specified under section 115 BBI shall be subject to 30% tax. Next slide. Next slide, please.
Yeah.
Now, the very key amendments is the maintenance of books of account. Now, from this financial, the proposal is to make additional condition that the books of account and other documents are kept and maintained in such form, manner, and such place as may be prescribed. Though maintenance of books of account was an implicit condition because there was a requirement of audit, but after this proposal, this has become a very explicit requirement. But we need to wait for the rules. We shall provide the form of accounts or the manner of keeping accounts or the place where it should be kept. At the same time, section 1310 has also covered this situation that the books of account are not maintained in such form, in such manner as may be prescribed, then the income shall be charged, but the special provision as provided in section 1023C. And similar amendments are also proposed under section 1023C. Next slide, please. Now, another amendment, very key amendment, is the cash basis accounting. It is now explanation has been one explanation after section 11 has been added, that it is proposed that the amount of applications shall be considered only if it is actually paid, irrespective of the year in which liability arises and irrespective of the method of accounting regularly employed by the organization. Our understanding is that the proposed change has settled the controversy as to how the amount applied for shall be determined, but at the same time, there will be accounting challenge to determine the application amount on the cash basis where the accounts are maintained on accrual basis, like section 8 company. And in certain cases, it will also go against the TDS provisions, which are also applicable to the NGOs, because we all know in the TDS provisions, sometimes we have to deduct TDS before paying at the time of creating the liability. And next slide, please. Manoj, you will take up or?
Yes, yes. So cash basis accounting, if you see, this is very important thing that section 11 starts with the word the person in receipt of income. So income side was always cash basis, and the expenditure side there was no clarity. Now this year it has said it is cash basis. So there is only one exception under explanation to section 11(1), which says that if the income was not received during the year, then it can be applied in the year which it is received. So to my understanding, barring this particular aspects and a particular type of income, it could be also a TDS to just align the 26A's compliances. Barring that, the law is very clear. It will be cash basis on both sides, but these two, three exceptions are still permissible in the light of explanation to section 11(1).
Next slide, please. And the last amendment is the voluntary contribution for renovation and repairs of released spaces notified under clause B of subsection 2 of section 80G. And normally the benefit of section 80G are not available to religious trust. And in the case of a religious income charitable trust, the approvals are given only when the religious purpose expenditure doesn't exceed 5% of the total income. However, there is another section 80G2B, which enables the religious trust being a place of public worship throughout any state or states, and as notified by the central government, then such religious trust can apply for ATG approval under section ATG2B, and they can avail ATG benefit. But in those cases, those trusts and those repairs and renovation work should be notified by the central government. And the proposal amendment is to bring certainty on the treatment of such voluntary contribution received by such trust on such approval. And it provides that the amount of voluntary contribution received by under such approval can be treated as corpus at the option of the recipient NGO. Normally, the corpus is treated as corpus at the donor's declaration, but here the proposal is saying that if this repairs and renovation donation or contribution received under ATG is specific approval, that can be considered as corpus at the option of the recipient NGO. At the same time, it says, next slide, it has to follow the following condition. The corpus has to apply for the purpose for which the voluntary contribution is received. The corpus shall not be applied for making a contribution or donation to any person. That means this contribution again cannot be applied for making a contribution or donation to any other person. And this corpus amount has to be maintained as separate identifiable in 11.5 mode. That means this corpus can be spent only for voluntary contribution for the same purpose, and no intercity donation. It has to be maintained separately in 11.5 mode. And it's again, next slide. Next slide, please. And it says, if any trust or institution has stated any sum received by it as a forming part of corpus, and subsequently any of the specified conditions is violated, then in that case, such sum shall be deemed to be the income of such trust of the previous year during which the violation takes place. That means you have not kept the money in specified mode, or you have given interchange donation, then those violation amounts shall be considered as income in the year in which the violation takes place. Next slide, please.
I think this amendment is specifically for those notified religious institutions. I don't think it is, this amendment is for all the religious institutions, because religious institutions are not eligible for ATG benefit. Religious institution can avail ATG benefit only if the religious activity is below 5% of the total activity. So I think that's it.
So, next slide.
Yeah.
Thank you, sir. Can we take few queries before you
Yes.
go?
Yeah.
So, first one is from 1 second. First one is basically, what is the relevance of section 164 subsection 2 after the insertion of section 115BBI? How to deal with the inconsistency between these two provisions?
Hana, because there was a need for a corresponding change in 164. So what we understand that after this amendment, as long an organization is approved under 1023C or section 12AB, then the taxation, whether they are under the violation category, violation under section 12A, conditions of registration, violations of forfeiture, the specified violations which are done by the assessing officers, all would be taxed under section 1310. So now there is no concept of getting the slab rates. The slab rates in section 164 will become relevant only if the registration is cancelled. So otherwise section 1310 will prevail under all circumstances. We don't see any type of tax which could avail the normal rates. It will be at the marginal 30% rate.
Okay.
Not only while making the assessment, 164.2 provides that in the case of 113(1)(c) violation or 13(1)(d) violation, there should be maximum marginal rate tax.
Right.
But 115BI provides the 30% tax. So they have not made corresponding change in 164.2. So there will be certain anomaly how to deal with this situation, because the same violation 2 rates are provided now.
But this is, the new amendment will prevail, so that what we should take.
Okay. So another question is from Shama Vallabhadas. She asks that there is a code called specified violation includes non-compliance with other laws in section 12AB. Is little vague because the word other laws can include petty offenses like traffic violations made by driver. Is this so wide?
No. There are two things. One, that violation should have reached finality. That means some particular court should have decreed. So it is not the violation per se will result a cancellation proceeding.
Correct.
And the violation should be such that it is material to the advancement. So those laws should be in such, it cannot be a traffic law and other things. So the law should be material to the purpose and advancement of it raises a question mark on the integrity of the trust itself. There is a direct violation, direct misappropriation of fund. So that way that law should be material and it should have reached finality.
Okay. And one more before we go. Can registration be cancelled for violation of section 13 subsection 1 clause D?
this registration, incidentally, this particular section has not been included under the specified regions. So what we understand, there are two. It is very important. This is a very good question. There are two things which have been left out of this section, specified regions for cancellation. One is this investment. The other one is violation of section 215. Section 2 provision to section 215, doing commercial activity in the primary objects. So what we understand that these are the, if there are repeated violations of the investment clause, or if there is a violation in section 215 regarding the organization of commercial nature, then the commissioner has to invoke the residual clause challenging the genuineness of the organization. Under that section, the cancellation will happen. It is not that you can get away by violating the investment, but your first violation may not result in a cancellation proceeding regarding investment.
Okay. Interestingly, investment violation was a condition presently. Though 215 violation was not a condition now also. So I don't know how they have escaped this investment violation as a special condition. Maybe their omission.
It has been missed out because section 15(1) violation was a part of cancellation sections, but it has somehow missed the attention.
Correct. Just one more before we leave. Can trust carry non-incidental business after insertion of new cancellation provision under section 11, subsection 4?
Yes, this is the fundamental problem which has been created of this amendment, because they are saying that the violation will include engaged in non-incidental business. Now, quickly, I will say there are three types of commercial activity which has been provided in the Act. One, section 215, where the primary activity is done on commercial purposes. Then you have section 11(4), where business is held as property of trust.
Right.
And then you have section 11(4)(a). The amendments have been made keeping in mind only section 11(4)(a), that incidental business, they are negating various case laws. That last month only Delhi High Court said that the money is applied for charitable purposes, it will be treated as an incidental business. So maybe to negate these kind of cases, they have made this amendment keeping in view section 11(4)(a). But the language of the section is such, it seems that a trust cannot hold property at business of trust. So suppose a business is held as property of trust, that was permissible under section 11(4), but it seems that particular section has become infructuous. So it will be very difficult to have businesses which are not incidental. So this area may create a lot of controversies.
Right. I see queries pouring in. Can I ask for one more?
Yes, please do.
They say ask that religious organizations are not exempted. Then what about WAKF, WAKF? Are they exempted from tax?
No. The constitution of organization and the objects of organizations are two different things. Okay. As far as the Act is concerned, there is no, even an unregistered organization, a oral trust, a work, a board, whatever kinds of association or a form of people who do religious or charitable activity can avail exemptions. And they will avail exemptions if their activity are religious or charitable come religious. If it is charitable come religious, then the religious component should be less than 5%. Charitable come religious, less than 5% can have ATG. Charitable come religious, more than 5% religious can have anonymous donation. And charitable, so this is, but it will not make any difference whether it is registered as a work or any other form of registration.
Correct. So I think that's all. Thank you, Fogla sir. Thank you, Kejriwal sir. It was indeed a great session. Any last words you can say?
No, because the time was big challenge and there were so many nuances. So I don't think we were able to do justice to the but we are thankful for this opportunity and we are thankful to the participant for patiently listening us out. Thank you.
Thank you so much.